Well, I think it's useful to define first what financial integration is. The way we tend to measure it is by measuring how many assets in a foreign country domestic residents hold, and also how many assets in the country are held by foreign residents. So, for example, if I buy a share of Santander and I am a resident of the United States, I increase international financial integration because I hold a claim on a bank in Spain. And similarly, if Santander buys a bank in Argentina, that's an increase in integration between Spain and Argentina because one of Argentina's banks is now owned by a Spanish institution. In terms of order of magnitude now, for advanced economies, the amount of claims on foreign countries are often larger than GDP, than the size of the economy. They're often 200% of GDP, something like that. And the liabilities are of the same order of magnitude, broadly speaking. For emerging markets, the numbers are smaller. And of course, if a country is a creditor, there is a bigger difference between the assets and the liabilities. The assets are larger. If the country is a debtor, it's the other way around. I would say there are a series of possible benefits. One, I'm thinking in particular about emerging markets, is that integration may help financial deepening. And what financial deepening does is basically developing the domestic financial system. And what that does is to allow entrepreneurs, firms in the country to access capital markets more easily. They can borrow from a bank or issue a bond, and there are more financial resources from which people with good investment projects can tap. Also, another benefit can come from, say, technology spillovers. So if Volkswagen sets up a plant in the Czech Republic, that may increase productivity in the Czech Republic because there is learning from the sophisticated technology adopted by a firm from a more advanced country. And another form of benefit is what economists call risk sharing. What risk sharing means simply is that if in your portfolio you don't have only claims on your own country firms, but also claims on a different country's firms, you are somewhat less exposed to domestic risk. You have a more diversified portfolio. That's a benefit. Of course, the counterpart to that is that sometimes when a shock hits another country and there is more integration, then everybody is going to be affected a little bit more. So those are the two sides of the coin. Let me take a very simple example, which is the one of the beginning, the subprime crisis. So you had some securities backed by mortgage assets that were packaged and sold to investors. And some of these mortgages were of very low quality and basically predicated on the assumption that house prices would only go up. When house prices slowed and these people found themselves unable to service the mortgages, the pain was not limited to US investors, which would have been the case had there been no integration. And the reason is that many banks of other countries, particularly the UK, France, Germany, Switzerland, had bought these bonds. So clearly the international repercussions have been bigger because more bonds were held outside the United States. At the same time, had everything being held in the United States, you would have had a much more severe, even more severe shock in the US, and that may have had bad repercussions for the world economy anyway. So you have a US source shock which is distributed a bit around the world. What is very different across countries is the type of financial instruments, not just the size of the financial instruments they buy and sell, but also what type. So you have, to go back to the example I gave before, all these mortgage-backed securities backed by the subprime, the bad quality mortgages were basically almost entirely held in advanced economies. So banks in, as I said, in the UK, in Switzerland, in Germany, in France, not really in Spain, but in advanced economies. In contrast, emerging markets were holding primarily treasury bonds in the United States or securities backed by Fannie Mae and Freddie Mac, the big American mortgage guarantors. And those did not take a plunge. So you have really a difference in the typically more sophisticated investors hold instruments that are more complex and sometimes end up being riskier. Also, some countries have a lot of direct investment or portfolio equity investment overseas. They have an equity culture. The United States is one example. While other countries, say for example Japan, tend to hold more bonds because they tend to be more conservative investors overall. There is now a tremendous amount of uncertainty on international financial markets. Many financial institutions are going bankrupt, and because the linkages between financial institutions across countries are strong, the risks can spread. An additional problem, of course, is that by their structure, financial institutions have a relatively small capital base and a big amount of assets and liabilities on top of it is the credit multiplier. So a loss on the capital can force a financial institution to drastically reduce its portfolio size, try to sell assets, and this can lead to very large cumulative price declines, which is what we are seeing now. There is lack of confidence in counterparts, and some assets have no market anymore. And we know that those assets will have a value eventually, but if banks need cash now and nobody's willing to buy them, we have a very serious problem. Well, actually, the evidence is that the monetary union has actually accelerated the process of integration. And both commercial, so on the trade side, and also on the financial side. I think the main reason is that you have basically the removal of currency risk. So for an Italian investor now holding a bond issued in Germany or issued in Italy is exactly the same thing. There is no risk of currency movements. One of the consequences of this has been a very large increase in cross-border holdings, say by Spanish residents in Germany, by German residents in Italy, by Italian residents in France, and so on. So a big internal effect of financial integration. But at the same time, the fact that the euro area is now a very big area, is with a GDP of the size of the United States, it also becomes a more attractive place to invest for people outside the Union. And so overall, even the integration of the euro area considered as an entity with the rest of the world, not just inside the euro area, has gone up dramatically in the past 10 years. Emerging markets have done a lot of progress in sort of strengthening the structure of the financial system, in having more solid policy and more appropriate policy stance, both fiscal and monetary. And trying to strengthen the institutional framework, which has helped attract foreign capital. But clearly, when there are signs of institutional instability, you immediately see the consequences on external markets. Some types of capital may be a little bit less sensitive to that. For example, if you have a country which is a major commodity exporter, say produces oil, gas, you may have a lot of foreign direct investment in that sector, which can be to some extent a bit more shielded from some form of financial institutional weaknesses than, say, an investment in a bond market or in an equity market, where manipulation, other things can go on if the institutions and the regulators are not good enough.